The AI bubble may have just ended. AI revenue just crossed the line that matters. In the first quarter of 2026, global AI sales outside China reached an estimated $25 billion. The estimated depreciation cost of the chips and data centers behind those sales was $21 billion. Revenue cleared depreciation for the second consecutive quarter. This is the first serious evidence that customer demand may be catching up with the infrastructure bill. It is not profit. The remaining $4 billion still has to cover power, labor, financing, software development, and every other operating cost. The report says the margin for error remains narrow. What the number proves: depreciation is the annual accounting cost of the hardware already installed. If AI revenue cannot cover that cost, the infrastructure is not paying for itself at the most basic level. Now it can, at least under this model. Exponential View built the estimate from spending across more than 1,000 companies and adjusted it to avoid counting the same customer dollar twice as it moved through the supply chain. Its model put generative AI sales at $110 billion over the past 12 months, with the latest month implying an annualized run rate above $175 billion. That moves the debate forward. The question is no longer whether AI has meaningful revenue. The question is whether that revenue can keep outrunning the cost of the build-out. The assumption that can break the chart. The entire crossover depends on how long the hardware remains useful. The model depreciates computing equipment over 6 years. If the same equipment becomes economically obsolete in 3 years, its annual depreciation cost roughly doubles. That could erase the crossover. There is evidence supporting the longer life. The rental price for NVIDIA's H100 reportedly remains near 80% of its launch level as the chip enters its 4th year. AWS has also said it has kept 6-year-old A100 servers running because customers still demand them. Amazon says chips, servers, and networking equipment have useful lives of roughly 5 to 6 years. New chips handle the most demanding models. Older chips can move to smaller models, internal tools, and routine inference. Faster hardware does not automatically make the previous generation worthless. Demand is real. Financing risk is real too. The biggest technology companies may spend as much as $725 billion on capital expenditures in 2026, much of it connected to AI infrastructure. Amazon alone expects to invest approximately $200 billion. Its shareholder letter says a substantial portion of planned AWS spending is already supported by customer commitments, including an OpenAI commitment worth more than $100 billion. AWS CEO Matt Garman says near-term server purchases use customer demand data, and customers often make 3 to 5 year capacity commitments. That is observable and contracted demand, not a blind bet on empty data centers. The financing risk has not disappeared. It is moving towards specialized AI cloud companies that rely more heavily on leases, debt, and equity. If demand slows or hardware values fall faster than expected, these firms have less room to absorb the hit. AI can be economically real, while parts of the financing structure remain fragile. What to watch next? 3 numbers now decide whether this crossover lasts. First, revenue growth. The revenue line has to keep rising faster than depreciation. Second, hardware life. 5 and 6-year-old chips have to remain productive enough to justify the accounting assumptions. Third, the profit left after depreciation. Power, labor, financing, and constant upgrades still have to be paid. If those 3 numbers improve together, the simplest AI bubble thesis is wrong. If revenue stalls, hardware ages faster, or financing costs jump, this thin cushion disappears. The AI bubble did not end because spending slowed. It may be ending because demand finally reaches the cost of the machines. Revenue has cleared depreciation. Now we find out whether it can clear everything else.